Now I want to talk about income statements. And in this chapter, we're going to see two types of income statements. And the two types here are just two different presentations that would lead to the same values. In the very first chapters, we covered the income statement in a way that was very simple, where we've seen revenues minus expenses. In merchandising businesses, the income statement would get a little bit different because there's cost of goods sold involved. So we're going to start with a multiple step income statement, and in the multiple step income statement, as the name implies, there are more than one step that we have to follow. So it contains several sections, subsections, and subtotals, including the following items. So we start with sales. We have to get the cost of goods sold and the gross profit, income from operations, also other revenues and expenses, and then at the very end we'll get to the net income. So the total amount of sales to customers for cash on account is reported in this section, which is the sales section. So whether it's in cash or on account, they are combined together and we call them sales. So we really don't differentiate between cash sales and credit sales or sales on account. Then in the next section we have the cost of goods sold, and this is the amount of cost of goods sold to customers would be reported in this section. Cost of goods sold may also be reported as cost of merchandise or cost of sales. So sometimes they call it cost of merchandise sold, and many businesses they just simply call it with a short name cost of sales. However, I have to say that the most commonly used expression for cost of items sold is the cost of goods sold. Then we have the gross profit, and the gross profit is basically the difference between the sales and the cost of goods sold. So once we get the sales, we subtract from it the cost of goods sold, we get the gross profit. So these are typically the first three lines in any multiple step income statement. We start with sales, we deduct cost of goods sold to get the gross profit. Now let's see the income from operations. And income from operations is typically divided into two parts. We have the selling expenses and administrative expenses, where we have to subtract them from the gross profit to get into the income from operations. So as it says here, sometimes we call it also the operating income. And how it's determined? It's determined by subtracting operating expenses from gross profit. So what are the operating expenses? Again, as I said, operating expenses, they consist of two things: the selling expenses and administrative expenses. In simple words, selling expenses are all the expenses related to selling, like marketing, promotion, advertising, delivery expenses, sales salaries, commissions to salespeople. Administrative expenses, these are all the expenses that are related to the office or to administration. Sometimes they refer to them as general expenses. So some examples would be office salaries, depreciation of office equipment, office supplies, even salaries to like secretaries and things like that. Then we have other revenues and expenses, and these are income and expenses that do not belong or do not relate to operations of the business. And we have, again, two categories. One is the other revenues, and it could be also other expenses. So other revenue is revenue from sources other than the primary operating activity of the business. Like what? Like income from interest or rent revenue. That, imagine we have a building or a warehouse that we're not utilizing, and we're just renting it to another company. So in this case, the income that's coming from it is considered to be income that's not from the primary operation of the business, because we're not in the rental business, but we have this extra warehouse that we're renting out to another company. So that would be another revenue. Gains resulting from the sale of fixed assets. So we have an old asset that we decided to sell, and we made some kind of gain in this kind of selling transaction. So that would fall under other revenue. For other expenses, these are any expense that cannot be traced directly to the normal operations of the business. Another example would be interest expense, losses from disposing of fixed assets. Again, very similar to what the other example, but in this case, we're just getting rid of an asset, an old asset that we used in the business, but we sold it for a value below its book value, so that led to a loss. So other income and other expenses are offset against each other on the income statement, If the total of the income exceeds the total of the other expenses, the difference is added to the income from operations to determine the net income. If the total of other expenses exceed the total of the other income, then the difference is subtracted from income from operations to determine the net income. So in other words, if the other revenues are more than the other expenses, then we have a positive number that we add to income from operations. If the total expenses is more than the other revenues, then we end up having a negative value and we subtract it from income from operations. And the bottom line number would be always net income. If the net income is a negative value, we call it a net loss. We have to write it down as a net loss. And in the next slide, we're going to see how it looks. So this is an example of how the multiple step income statement would look like. And you can see we started with sales, we subtracted the cost of goods sold to get gross profit. And then we subtracted the operating expenses consisting of its two main categories, selling expenses and administrative expenses. Remember, administrative expenses, sometimes we call them general expenses. And we listed some expenses here and there, get their totals. And by the way, we usually like to have a total written in a column, and then we have a sub-column to record the total. So now we have the selling expenses, 70,820, the administrative expense of 34,890. We add them together, which is the 105,710, and we call that total operating expenses. And you can see here that we move to the other column. We deduct the 105,710 from our gross profit to get income from operations, which is 82,240. Then the last step is to add or subtract other revenues and expenses. In this case, we have rent revenue of 600. The interest expense is more, 2440. So we end up deducting this value, which is 1840, which represents other revenues and expenses. When we subtract 1840 from 82,240, we get net income of 80,400. Okay, so that's how it's presented, the multiple step income statement. We'll see next the single step income statement, and then you'll find that it's much simpler because we combine all the revenues together, all the expenses together, and that's how it looks like. There's a checkup corner. I'll let you try to review that yourself, and I'll jump to the single step income statement. So the single step income statement, it's an alternative form of income statement presentation. The single step form deducts the total of all expenses in one step from the total of all revenues. So it's very simple. It's very similar to what we've seen in the past for service businesses, where we combine the revenues, expenses, and get their differences. So the single step form emphasizes total revenues and total expenses in determining net income. What is the criticism for it? The major criticism is that gross profit and income from operations are not reported. So basically, you can get the net income, but you cannot get details about gross profit and the income from operations. So other revenues and the revenues are combined together. Unrelated expenses are combined with other expenses, and it's hard to tell what is coming from what. So this is how it looks like, and you can see it's much shorter, much condensed, but at the very end, the net income is the same. There's no difference between the multiple step and the income statement. We got the 80,400. However, you can see that we got the total revenues where I combined the sales and the rent revenue in one category, and the expenses, we have the cost of goods sold, selling expenses, administrative expenses, and the interest expense all combined, and we got their total. Get the difference here, and the net income is 80,400. So one other thing that we're going to see in this chapter is how the retained earnings would look like for a merchandising business. And I just want to let you know it's exactly the same. So we start with the beginning balance of retained earnings, we add to it the net income, subtract the dividends to get the changes in retained earnings, and then you get the retained earnings balance at the very end of the year. Very similar to what we've seen in the previous chapters for service businesses. Same thing for the balance sheet. The balance sheet, we expect to have it exactly similar to what we've seen in service businesses. So the only difference here, we see that we have inventory, which is the 62,150, and other than that, I think it's very similar to what we've seen before. Now let's talk about something related to merchandising business, which is inventory shrinkage and how we can adjust for that. So under the perpetual inventory system, the inventory account is continually updated for purchases and sales transactions. As a result, the balance of inventory account is the amount of merchandise available for sale at that point in time. However, retailers normally experience some loss of inventory due to shoplifting, employee theft, or some kind of errors. Therefore, the physical inventory in hand at the end of the accounting period is usually, in most cases, is less than the balance sheet of inventory. So the difference, we call it inventory shrinkage or inventory shortage. And let's see how we treat it in accounting. So we have an example here about Net Solutions. The Net Solutions inventory records indicate the following on December 31st, 2019. They have account balance of inventory for $63,950. They have physical inventory in hand of $62,150. So the records show a higher value compared to what we have in hand. Like if we do the physical count, we find that it's only $62,150. But if we look at the records, it's more. So in this case, we can identify there is inventory shrinkage of $1,800. So at the end of the accounting period, inventory shrinkage is recorded by the following adjusting entry. We reduce the value of inventory by the amount of inventory shrinkage, which is the $1,800, and that's why we credit inventory by $1,800. And on the debit side, we just record cost of goods sold. So we debit cost of goods sold by $1,800. So after the preceding entry is recorded, the balance of inventory agrees with the physical inventory in hand at the end of the period. One other thing that we normally do is closing entries. And closing entries, they are very similar to what we've seen before. So it's exactly the same. I'm not going to spend too much time over this, but just want to refresh your memory where we debit each temporary account with a credit balance, such as sales and anything with a revenue nature. Then we credit each temporary account with a debit balance, like all expenses, including the cost of goods sold. So we debit the income summary for the amount of its balance and credit the retained earnings account. The account debited and credited are reversed if there is a net loss. And then the last step is that we debit the retained earnings account for the balance of the dividends accounts and credit the dividends account. And here is how we usually present it. So you can see here the list of the first one, closing the revenues, closing the expenses, closing the income summary, and then finally closing the dividends. And then as you can see here in these slides, we have the account for income summary, which shows closing revenues, closing expenses, and then closing the income summary itself. So after the closing entries are posted to the accounts, a post-closing trial balance is prepared. The only accounts that should appear on the post-closing trial balance are the assets, contra assets, liability, and stockholders' equity accounts with balances. In other words, these are what we call them the permanent accounts, the real accounts. So these are the same accounts that appear at the end of the period balance sheet. If the two totals of the trial balance columns are not equal, an error has occurred that must be found and corrected. One last thing in this chapter is some kind of ratio analysis. So we do some analysis for decision making, and the ratio that we're going to be talking about today is asset turnover ratio. So as the term implies again, it says how many times the asset can help us in generating sales. So how many sales can be generated by using the assets that we have. So this is considered to be an efficiency or efficiency kind of ratio, and it also shows the effectiveness of using sales or using our assets to generate sales. So the asset turnover ratio measures how effectively a business is using its assets to generate sales. A high ratio indicates an effective use of sales. The asset turnover ratio is recorded as follows, where we get sales divided by average total assets, and this is how we get it. So how we get the average total assets is simply beginning assets plus ending total assets divided by 2. So let's see a numeric example. The following data in millions were taken from recent annual report for a store that I hope you know, which is Dollar Tree Incorporated. We have year 1 and year 2. Their total sales were $73,894, and then in year 2, $78,040. And then we have their total assets. We have the beginning of the year $23,029 in year 1, end of year $27,502. And in beginning of year 2 is $27,502 and end of year $2,772. I don't know if you noticed, but end of year 1 should be the same as beginning of year 2. So that's something that in accounting we treat it all the way, always that way. So ending of 1 year is the beginning of the 2nd year. So the asset turnover ratio for each year is calculated as follows. We got it as 2.84 for year 2 and 2.91 for year 1. But how did we get it? We simply got the sales and we divided by the average total assets, and where we got the beginning plus ending divided by 2. Same thing for year 1. You can see here that there's a slight decline from year 1 to year 2. Is that really something disturbing? Again, I would say this is not too disturbing, because in businesses it's very difficult to maintain very close ratios. As long as it's not changing significantly from one year to another, I think the company should be in good shape. But in this case, going down from 2.91 to 2.84, I won't say that to be a significant changes. So by that, I conclude chapter 5. I hope this is something that would show you the accounting perspective for a merchandising business. In the next chapter, we'll focus more on inventory, which I think is a very interesting topic to understand too. All right, good luck, and I'll see you in the next video.